Welcome back to another episode of an Investor's Journey podcast. I am your host, Jonathan Barbera. And if you are enjoying these episodes, please subscribe and leave us a feedback, some comments. Let us know what it is that you want to listen to moving forward, because I do come across a lot of you in networking events and stuff. And then at those points, you tell me, I really wanted to learn more about this one topic. And it's like, just comment below so you don't have to wait that long. And I can definitely put out some content a lot sooner than that. So make sure you do that if you're interested in anything that we're talking about. If you want me to break something down further, or if something didn't quite make sense. Continuing, this is going to be part 3 of the series that we did. So we first started off with how to do wholesaling, then we did how to do flips, and now we're covering how to do buy and holds. So this is going to be the last part of this. It's, I think, the 3 major pillars of single-family residential. In our opinion, the things that we enjoy doing. Of course, there's many more things to do, but in our opinion, this is what we believe is the 3 major pillars. So in this episode, we're going to cover how to buy rentals. This is episode 42, and there's going to be a couple things in here that I'm not going to really address, like especially on the rehab side of it, because I have addressed it prior on the fix and flip one. And the same as generating the leads, we addressed it on the wholesale one. So it's kind of, if you use all 3 combined, you can kind of piece together the different strategies. So what are the benefits of buy and hold? What is it that attracts so many people and that we personally love tremendously about buy and hold? Is one is appreciation, right? If you buy in the right areas at the right time, depending on where your market sits, you get to capture that future appreciation of real estate. And real estate, really, in any course of 10 years, it always goes up. So until the dollar completely evaporates and they create a new currency, home prices are always going to rise, right? So you're never going to lose money in buy and hold. And appreciation is a really good aspect of this opportunity, which is, I guess, my thing against note buying or creating notes is that you don't get any of that appreciation, right? You sell it off and that's it, unless you get the note back and you can restructure one. That's not to say that there isn't a place for notes. It's just not a fan of it. Another great benefit is cash flow, right? You have, if you do things correctly, as we're going to dictate in this, share with you in this podcast, you stand to make good amount of passive cash flow, passive income coming into you on a monthly basis that you can count on, right? This is going to definitely help you to reach that financial freedom that so many of us are striving for, because you can count on a certain amount of equity coming in consistently. So you can kind of predict that level a lot easier through rentals. And you also get equity pay down as well, right? So you're getting somebody to not just give you cash flow, but also pay down your mortgage. And that is huge, right? You're just creating that spread more and more, and that's just awesome. Somebody else is doing it for you. Then you get depreciation, tax advantages, right? You get to depreciate the asset, a lot of the stuff inside the house and everything over the course of years. And that's going to help you if you have, especially if you have an income, a W-2 job or something like that, and you get taxed on that, the depreciation from your rentals can offset that. So then you're actually getting taxed a lot less. And we all would like to get taxed a lot less. So depreciation is great. And then leveraging at low interest rates. When you build enough equity in your rental portfolio, which we're going to cover how to do that, you can start pulling lines of credit, loans against these properties at very low interest rates, right? And when you pull that money out, that you refinance these properties, that money that you're pulling out is tax-free because it's already part of the property. So you're not paying taxes on that amount of income, on that money that you're pulling out, and now you can reinvest that capital. So we're going to talk about that in a lot more detail moving forward, but huge advantages. So we've covered it before, and everybody has heard the BRRRR strategy, right? Buy, rehab, rent, refinance, and you can add another R, which is repeat. So we're kind of going to break down that BRRRR strategy step by step, just because it makes sense, to do it that way. It's how we like to do it. So here we go. First things first is the analysis. Just like the fix and flip episode, you have to do the analysis. Very important part. The majority of the whole rental space, of whether it's going to be a good rental or not, whether it's going to make sense or not, is done in the analysis part. If you do not do a good analysis on your rentals, that's how you get into very bad rentals. All right. So this is the time that you definitely want to dedicate a lot of effort and a lot of time into. So the first thing is determining true value. Same as the fix and flip. The difference here is we want to determine what is the ARV versus the rent value. This is something a lot of investors, especially wholesalers, screw up on. And this causes you to screw up as well. So just because the ARV is, let's say, 180, that does not mean that to get the house rent ready is going to become an ARV of 180. So let me break that down a little bit better. So we got a wholesaler brought us a deal a while ago, gave us an ARV of 180 or around there. We'll use 180. And told us, the rehab possibly for this house was going to be about like 15 grand, 20 grand, right? To make it rent ready. The issue is that doing that 15, 20 grand to make it rent ready doesn't make it ARV quality, right? Rent ready is not the same as ARV. And you need to understand that difference, because if we go based on what they were trying to sell, we run the numbers on ARV with the repairs of rent ready and we're off, right? So I'm looking at ARV and it's like, yeah, if you run those numbers, you are about at 80%, right? And we're going to talk about that, but you are about at 80%, which sounds great. But the problem is that the 20 grand that I'm going to put into the house is only going to make it rent ready, not the 180. And rent ready, I think at the time when we were running the comps, it was about 160, 165. So where you need to run, and this doesn't mean don't buy the deal, but don't run your numbers at the 180. You got to run your numbers at the 160 if you're only going to do the 20 grand, right? If you wanted to do the 35, 40 grand that the house actually needed to become ARV, now you can run the numbers at 180, but then your rent comes into play. How much is your rent going to be? Because then if you're in it for too much, then you're going to have a lot of money invested in this property, right? Which is fine. It's just you need to understand these numbers. You need to understand, are you bringing it to me ARV, and is that the same as rent ready? Or is ARV up here and rent ready down here? What is that variation going to be? And then when you do another aspect of determining the value is running the rental comps, right? I want to look at what does this house need for me to do to it to make it rent for the pretty much what the rents are going for in that market. Do I need to bring it to ARV status, or is there a tier below that is just good enough to get it rented for that price, right? So those are the things that I want to look at, because what I want to do as an investor is determine whether I need to do just enough to get it to that point. Because if I over improve, that doesn't mean that I'm going to get a higher rent for it, right? All that means is maybe I get it rented quicker. And we're going to talk about the benefits of over improving on rentals, but you want to be able to run that. You want to distinguish that difference. So you want to look at the rents. So you say, okay, yes, the ARV is 180 and the rents are 1,400, but the houses that are renting for 1,400 don't need to be ARV quality, right? That means granite countertops, brand new kitchen, maybe some crazy, open design or whatever it may be. Maybe for 1,400, all it needs to be is just a clean house, right? It's okay that it has Formica countertop and Home Depot cabinets. As long as it's a clean house in that area, it's going to rent for 1,400. So that is going to influence the price. But now, if you're going to just leave Formica countertops and Home Depot cabinets, what do those houses sell for? Because that's no longer ARV, right? And where does this become a big issue is in the refinance part. So when the bank comes out here to refinance this property and they look at those houses and they have granite and brand new kitchens and brand new bathrooms and yours is just cleaned up, it may not appraise. And that could be very, detrimental to your numbers. We've had it where it still appraises for the full ARV for whatever reason. That's a happy day, but you can't expect that to happen, right? You need to run your numbers as they should be. So I hope that makes sense. And again, it's very involved. So if you have any questions or anything like that you want me to break that down further, let me know, and I will do that. Another thing is the rule of thumb usually for rentals is about 80% minus repairs. So we did the whole ARV formula for flips, right? 70% of ARV minus repairs gives you more or less where you need to be. This is the same thing, and the reason for 80% is because majority of lenders will lend up to 80% of the value of the house, right? So if you can do 80% minus repairs, then that means that when you refinance, you're in it for no money, theoretically, right? So you got to be able to gauge that. Sometimes, especially when you're looking to pick up a lot of houses, you might want to be at a higher debt to equity ratio, more like 75, 70%, just because it looks a lot better and you get much favorable terms. But usually, the majority of the lenders will refinance at 80%. So that is a good number to be at, because then that factors in, it also factors in if you need to sell quickly or something, you have that spread of realtor fees, closing costs, and maybe a little bit of profit for you. So you want to build in that cushion in there. Now, what matters with this is that, let's say you're buying, well, we'll cover that next. But so 80%, the reason that matters is that there's a lot of times that you have a really good house. Like we bought in the past before. We love the neighborhood. We love the area. The rents are good. We see the appreciation coming because of all the changes that are happening there. But when we refinance, we do have to come out of pocket a little bit, right? 5, maybe 10 grand out of pocket, because we need to make up that difference, because we didn't buy such a killer deal. But we are in a great market, and now we're way over that 80% because of the appreciation and the growth that area has received. So those are things you want to gauge as an investor. Not every deal needs to be a home run. That's where you have to have a balanced portfolio, right? So I hope that that's coming clear. Now, what is the difference between turnkey and implementing the BRRRR strategy, right? So BRRRR is pretty much your buying, and the biggest R there is the rehab. Through rehab, that's where you can build equity. That's where you can build a bigger profit margin as well as higher cash flow, because the higher that percentage is from where you're going to refinance. So if you're going to refinance at 80%, it's not the same as if you refinance at 70%. That mortgage payment is going to be substantially lower at 70% than it is at 80, right? And if the mortgage payment is lower, your cash flow is higher. So that is the benefits of acquiring it. But the problem is that you're going to have to buy a house that needs work. And if it needs work, then you need to manage these contractors. You need to find them. You need to understand what work needs to be done. It's a lot more involved, all right? But a turnkey property, usually you're buying something that is exactly turnkey. That means that you buy it, you go and put a tenant in it, right? The house is ready to go. It doesn't need anything. The issue with that is that you're not typically going to get, well, not typically, you're definitely not going to get 80% minus repairs, right? You're going to be paying close to retail, and you're going to have to come out of pocket, 15 to 20%, depending on what kind of discount you're able to negotiate to get that spread, to get it financed. So you're going to come out of pocket more. But that's also an option, again, over the course of 10 years. And that's why buy and hold, that's how you need to look at buy and hold. The buy and hold is not short term, it's long term. It's how you build that wealth over the years. So look at it that way. Just because you're in it, a lot closer to fair market value, it doesn't mean that it's a bad deal. As long as the deal cash flows, you're good to go. And if you're in a good area, in a good market, you're good. You understand? Over the course of the years, you're going to build that equity up. And then you will be at a better position where you're more, cashed out of that property. And we'll cover those things too. So those are the two things you got to kind of figure out on your own. When, do you want to do turnkey or do you want to take on doing the work? Taking on doing the work, there's a lot of risk. I get the profit and everything is very enticing, but I don't see many people execute it correctly when they have full-time jobs. So it's very risky. Be cautious when you're doing that. Another thing is that we're in the analysis part is scope of work. You want to put in a good detailed scope of work. And again, this is using your rental comps. So you want to pull the good rental comps and see, all right, what do I need in this property? And the biggest thing is when you're putting all these scopes of work and everything together is that quality matters, right? So you want to definitely put in the right quality products in the house, because especially if you're planning on keeping it 5 to 10 years or even longer, you want to make sure that you have products that are going to last that. Because if you have a tenant turnover, let's say every year or every couple years, and you have to go in there and replace the carpets or replace all these things, you're not really making too much of a money on cash flow, because turnovers and stuff like that, they can essentially cost you a year's worth of cash flow, right? So you got to be smart about the stuff that you put in there. And in our rentals, what we prefer to do is we use a laminate stick down that looks like wood, and it's a glue down product. It's extremely durable. So even if they scratch or something, you just peel up that layer and put down a new layer. It looks like wood. And we run this from bedroom to bathroom to kitchen, all throughout the whole house, because it looks good and it's going to last forever. The house can flood and that product is still going to be there. So it's a great product. The same with cabinets, right? On a lot of our projects, we were criticized once because they said, well, you like to flip your rentals, do flip quality. I was like, well, yes, because if I do great quality work on my rentals, I can demand the highest market rents. And not just that, but moving forward, any appreciation that happens in that market, rent or value wise, we get to capture automatically because we're updated. We're at that level. Right? So there's not much that we need to do on tenant turnover, except for if they screwed up the walls a little bit, we do some touch-up paint and get the next tenant in there right away. So we try to keep our tenant turnovers within like a couple weeks. That way we don't lose much, if anything, and that goes into the quality of stuff. And that's why we do take that time to put in quality products, and especially I love buying the really, really ugly houses that we have to do everything to. Like right now, we have 2 rental properties that we picked up that we're doing foundation, all the plumbing, electrical, siding, roof, kitchen, bathrooms, doors, everything. We're doing everything because the house was trashed, right? But what's great about that is that I know everything is brand new for the next 5 to 10 years. So I don't have to worry about anything. You know what I mean? The maintenance calls are going to be substantially lower. All of these things are going to be so much lower and so much more beneficial to us as we move forward with that rental. So again, think about the future of this. Rentals are not flips. They're not something that's quick. You shouldn't think about them that quick. You should think about, I'm going to be holding on to this for the next 5 or 10 years. What is the work that I need to do now? And that's going to become a big negotiating factor when you're picking up houses. And this is something that we covered in the last episode, is that fear of missing out, where you do terrible negotiation because you want to jump in. You want to make sure you factor all these things in. And just because it'll make sense as a rental, don't overpay for it right now, because then a year down the road, the AC goes out because it was 30 years old and it goes out. Now you got to spend $4 or $5 to replace that AC air conditioner unit, plus all the headaches and pain that you're going to cost the tenant while they're there, right? Because it's always going to go out in the middle of July or August, right? The hottest times, especially if you're in San Antonio. It's like 1,000 degrees here. So it's always going to go out during that time, and it's going to be terrible for your tenants. So you want to make sure that, you're protecting your tenants, you're protecting yourself by factoring that in. How old is the AC? How old is the roof? What kind of electrical do we have? Try to predict when all these things are going to break, by how old they are, and then factor for that. So that is something that I believe very strongly about, and which is why there's Sometimes the people, they're like, oh, but it's a rental property. This is a great numbers for a rental. I'm like, no, they're not. Because this issue, this issue, this issue. Oh, but you don't know. I was like, exactly. And that issue, $5,000, can liquidate my cash flow for the next couple years. There's no need to rush into it. Buy a property that makes sense for you. Understand? Buy a property that you feel comfortable with buying. So I hope that this is all helping you. So quality matters. Again, think about the future. Think about future appreciation. Caption that rent when tenants move over, roll over, and everything. So you want to make sure to put quality products in your rental. Funding. This is something that's extremely important when it comes to refinancing and all of that. A lot of people like to or think that they should quit their jobs to become real estate investor when their goal is acquiring rentals. Never quit your job. All right. You will not have an easier time picking up rentals than having a W-2. When you have a W-2, banks are more willing to lend to you. All right. So if you have one, if you have a good paying job and you have great credit, don't quit. This is a great way for you to pick up rentals. You're going to qualify almost every time. So you want to make sure to keep that job, and you want to go ahead and interview as many mortgage brokers as possible. Don't go with your local bank. I get you have a relationship with Peter at the bank, but Peter may not provide you with the products that you need. All right. So try to go around, talk to different lenders, talk to different banks, even if you got to talk to banks outside of your state that can provide better products. Because there's a lot of lenders, especially the big banks that a lot of people bank out of, they give you crazy fees, high interest rates, or upfront points and all these things. You want to make sure to avoid all those things as much as possible. The point of this is to make a profit. And if your bank is charging you an arm and a leg or making it extremely hard to do, you don't want to do that. There's a lot of lenders as well, that, especially the ones that we use, we can refinance within 6 months. A lot of lenders won't allow you to do that. You got to season the property for 6 months or more, right? Which that means that you got to hold that property for 6 months or longer before you can refinance it. That's going to cost you money too, especially if you borrowed it to buy the house. So you want to make sure you run all that and you do the due diligence of finding the right mortgage broker. And then you want to see, does this house qualify for traditional financing right now? Because if it qualifies for traditional financing, then you might want to go that route just off the bat, right? And then even if you have to do a little bit of work to it or anything, that's money out of your pocket, but you're going to have a much lower mortgage payment and a much lower loan. So that means a quicker payoff, So that is going to help, but not all houses do. So now if they don't qualify, you got to determine, are you going to go private money or hard money? And we discussed this in the last episode, so please go listen to that part. But you need to borrow money to pick up the house maybe, right? Maybe you don't have the cash yourself. And if you have your cash, what you have to be careful and you got to speak to your lender about is, what are the terms for cash out refinances, right? Because when you put cash, there's no underlying loan. So then it's a cash out refi. And cash out refis, sometimes they tend to have longer seasoning periods or higher interest rates, or they'll give you less, right? Sometimes with other loans, they're able to give you up to 80%. But if you do a cash out refi, they might give you 70%. So it really depends. You want to make sure to find all these things out and what you need. We did an episode actually a while back with my business partner, John, on how we refinanced. So we did a subject to, and we took out a loan for the renovation, and we were able to package all that in one refinance. So I definitely highly recommend you go listen to that one, because it was a very creative strategy and it worked out very well. And a lot of people that pick up rentals that I know of, I reached out with that question and none of them had done it before. So definitely go check that episode out to really explain that process, and we cover a lot on that part. So like I said, the refinance and the seasoning, that's a big deal. You want to make sure to talk to them. And then you want to determine your return, right? Based on what the loans are going to be and everything, what is your cash on cash return going to be? What is your return on investment going to be? What is your cash flow going to be? And your cash flow, what you got to factor in is taxes, insurance, interest rate, your payment. Are you putting a property manager in place? Are you factoring in for deferred maintenance, for any, maintenance fees and stuff like that? Are you factoring in for repairs, for reserves? All of those things you have to calculate beforehand, because I always meet so many people that they're like, they buy a house and they buy it with the thought that they're going to cash flow maybe $200, but then they didn't add any of these costs or fees. So when they actually do refinance, they realize their cash flow is close to like $20 because there was all these extra things that they didn't account for. That's really bad, especially in the market that we're in. So don't do that to yourself. Run these numbers beforehand. And I've said this before, and especially with this one. This one took me a couple days to actually put together this outline, because there is so much to cover on picking up rentals, the same as picking up flips. I can literally talk about this topic for hours. So I don't want to do that because it's going to be a ridiculously long episode. But we are going to break these down, on different episodes in more detail, especially how to determine your cash on cash return, your return on investment. We have an Excel calculator that John has built out for us to just plug in the numbers, and it tells us automatically, based on what our interest rates are, based on all that, what our cash returns are going to be, what our return on investment is going to be, what our all-in cash is going to be on the project. So very, very useful tool, and we'll cover that in a later episode because, again, it's a lot to cover. So that's analyzing, right? You got to take that time, run all these things. It's a lot of things to do. So you want to make sure you qualify for loans, right? Speak to your lender, all of that. Then you want to make sure that you put a good detailed scope of work and you're factoring in future appreciation. And then you want to determine, are you buying, rent value or ARV value, the differences, the price differences, and all of that. So moving forward, that's the B in BRRRR. The first R is rehab. Rehab is the same as the flip episode. You manage every renovation. We manage all renovations the same exact way. There's no, we don't manage rehabs for rentals any different than from a flip. So go listen to that episode. I broke it down there, and I gave you a lot of other resources on that one. Next R is rent. So biggest thing when you are getting ready to rent the property is, are you going to self-manage or are you going to get a property manager? Now, for me, a property manager, all they really are is a tenant manager. They're not really a property manager. They don't manage the property itself. They manage the tenant. If the tenant has any complaints, any issue, they address it. Okay? This does not mean that they're going to keep up on your property. Property managers are very well known for putting band-aids on a lot of problems. All right? Because it's quick fix. That way the tenant is happy. And that's fine. But you need to understand that, because the house is your responsibility. The property manager's responsibility is the tenant. Your responsibility is the house, right? You need to understand when you get that, update from your property manager of all the little maintenance and repairs and stuff that they've been doing to the house, you want to go through. Where were band-aids put? Are there any things that I need to address further, right? Are there any things that are showing red flags that I need to address in the future that's going to cause a more expensive problem that maybe I can get ahead of right now? So be careful with that and be very aware. That's why a lot of people think that rentals are 100% passive. They are not. All right. No investment really is 100% passive. You should watch all of your investments. But rentals, you need to pay attention to the market. You need to pay attention to your house. All right. Because only you are going to know if there's an update or if there's something that you can do to this house to bring up the value, right? Or to get higher rent or to get it rented faster. So you got to determine that. Now, if you choose to self-manage, which is what we strongly recommend, especially if these are your first couple rentals, we recommend you self-manage because you learn a ton. You learn a lot about your tenants. You learn a lot about your properties. You learn about what to do, what not to do. On our first couple rentals, we renovated them how we renovated a flip, but we didn't realize that when you start living in a property that has just been put everything brand new, there are glitches everywhere because all these things weren't used before. So you don't know, what issues weren't done correctly. So it's made us much better rehabbers because now we pay attention to those things now. We're thinking, oh well, remember this. If we don't do this like this, they're gonna have problems down the road. And it was stupid things. It was usually like the exhaust fan. Like a lot of times on a flip, you just don't need to exchange them, even though they're old as shit. But then on a rental, we realized that because they were so old, they started making really loud noises, and sometimes they weren't working. And it's just better go ahead, replace them, put something new, give them a peace of mind, right? So stupid little things like that, but you learn about those. And then you learn about little tricks. So one thing that we recently implemented because we manage our own rentals is pretty much we charge an extra fee above the rental for coming in monthly, once a month, and changing out the air filter, the AC filter, checking out we have a lot of really hard water in San Antonio, so we clean out all the shower heads, all these things so they don't clog up and they don't act up. And we do an overall maintenance of the property, just making sure everything is functioning well. This gives you a chance to inspect the property, make sure that the tenants are not freaking growing weed in the house. And two, it gives you a chance to make sure that things are not getting too out of hand, right? So we had one property where the guy's AC, he kept calling us like, it's not working, it's not working. And it was working. The thing is that they had these two massive hairy dogs that were shedding like crazy because it's the summer, and it was clogging up the filter a lot sooner than was anticipated that you actually needed a change. So the AC filter, the intake was getting clogged, and then it wasn't sucking in any air, so therefore it wasn't blowing out any air. So those things can actually end up hurting your system tremendously because you're forcing the system to work on overdrive. So by us going and checking all these things, we don't have to rely on our tenant to do that, right? Because a lot of people rely on their tenant to take care of their property. And that to me is just really risky. I'd rather rely on us to make sure our properties are being taken care of. So that's a huge benefit of managing it yourself. And another big benefit is we did have a property manager on our first rental, and they called us that the sink faucet wasn't working in the kitchen. So we're like, all right. And they needed to call us for any repairs over $200. So it was kind of shocking that they were calling us. The bid had come out to like $580 to replace that faucet. Like, what the heck is the matter with you? Like, are you kidding me? $580 for that? What are you putting, like gold faucet in there? So we went out there. It took about all of an hour to go to Lowe's, pick up a new one, go there, change it out. And it took about an hour and like less than $100 to do it. You understand? So $500, if you have a $200 cash flow, that's, over 2 months of cash flow just wiped on that one little thing, right? So, and we had also the same issue with a concrete step that had pulled away from the house that we needed to replace, and they gave us a bid for like $750 or $800 to replace one step. I was like, all right, this is just beyond ridiculous. So managing yourself, the tenants will call us whenever there's an issue, but we can have our guys go out there for less than $50 and fix it. You understand? Because it's usually little stupid things. It's never really anything major. And even if it is, our guys are still cheaper than anybody our property manager is going to find online or Google or wherever the hell they shop for the most expensive contractors. So that's, project management. Property management. Choose if you want to do it yourself or if you want to get a property manager. Next thing, you want to price it right because that determines the speed. Right? You want to make sure that you can move this property quickly. You don't want it to sit on the market for too long. You want to be able to get tenants in your houses quickly. So I see this as an issue when I see a lot of people that they didn't buy the property smart. So they tend to jack up the rents, hoping that that's going to get them that difference that they need. The problem with that is that it tends to sit on the market even longer. And a lot of times what we've been seeing is that if you're too high on your rents, you're going to get tenants that are going to turn over within a year because they can afford a mortgage, right? So you want to make sure you're staying competitive. You're staying kind of competitive to what mortgages are because if not, you'll have that turnover at the end of the year. So you want to make sure you definitely price it right. And then you want to make sure you screen your tenants. I'm going to put on the show notes what we use to screen our tenants. I cannot remember right now for whatever reason. But screen your tenants. Now, we do have an issue here in San Antonio. So if you're listening to this right now, make sure you get with the city. Go to Alamo RIA Facebook page. We're putting information on there how to go represent, because right now they're trying to bring in the whole Seattle Renter Commission to San Antonio. And it has completely screwed up Seattle. And they're trying to do the same shit to San Antonio, all because this moron Trevino is trying to just get his political juice up and running. But, it's really going to screw up with landlords, and it's going to make the rentals a lot more difficult for everybody, including the tenants. But these idiots don't know what the hell they're doing. All they do is just push laws. So just get out there and definitely get some research done and try to support the community so we don't have this idiot pushing this through. But screen your tenants, to make sure that they don't have past evictions, criminal records, whatever it is that is high risk for you. We look at things that we also want to make sure our tenants are going to be good neighbors to our neighbors. So we don't want to bring in a sex offender, right, to the neighborhood. So you don't want your neighbors complaining about your guy, or, this couple that's just extremely loud or always fighting. I mean, you want to make sure to run a good background check. Credit score is not really that relevant to us unless their credit score is low because of bankruptcies or broken leases or things that show that it's bad because they can't make their payments or they can't hold a job. Other than that, we'll tend to be a little more lenient on the credit score. So screening your tenant, should you be too selective? That's really up to you. There's a lot of people that they say, I don't want animals and all this. The more selective you are, the smaller your renter pool is going to be. So I don't believe in being so picky on who our tenants are unless they hit those major, areas that we talked about before. But that's why we put the laminate flooring that we put. If you have dogs, if you have cats, it's fine. You know what I mean? It's going to be fine. You're not going to, we do take pet deposits and all that to make sure to protect it, that we don't want the dog pissing on the wall and stuff. But that being said, you don't want to alienate pet owners. And that's a large percentage of your renter pool. So being very selective is really up to you. It's going to make it a lot harder to rent. So that's something that you got to consider. And the last thing with renting is give them a welcome packet. A welcome packet with the contact information, emergency contact, what's expected of them. A lot of them don't know. A huge benefit too is John is a real estate agent, so we show them, we tell them we are one. So that way, when they decide to go ahead and buy a house, we represent them as a buyer's agent, right? So yes, they're moving out, but now you're making that commission from them buying a house. So it can kind of help out the business as well that way. So get a welcome packet, put a lot of nice stuff, maybe some local amenities of local restaurant places. Even if you have if you can go to a restaurant and get a gift card for your first night, here's a free pizza and some drinks on us, or there's a really cool bar, here's a gift card to go have some drink to celebrate your first night at our place. Get creative, right? These things are always very beneficial to your tenants. They feel appreciated and know it makes them kind of, be a little nicer with you, where they don't just bitch about everything, right? And then also keep track of their birthdays and major holidays and send stuff. We always for Christmas and all that to send little gift baskets or gift cards, and for birthdays and stuff like that. It shows a little more attention and makes you a better landlord. And a lot of times it's just that, if they're deciding of moving to another place to rent, that can help, right? Where they're like, well, our landlord is awesome, versus we don't know how this landlord is going to be. So that definitely helps. The refinance process. So this one is the one that took me the longest, because there is the whole financing of a rental is where really everything falls down to whatever. this is very involved. This is a big part. We were actually talking to one of our business partners, and we own a lot of rentals with him, that we're gonna possibly do a podcast at some point shortly, just about the refinance process, about the financing, about your personal finances, and all of that. This is a very important topic to keep in mind. So, but because we're doing the 20,000 foot view, I'm just gonna give you the cliff notes of the very important stuff, and then we're going to try to put that podcast together for you guys. But you did most of this work beforehand on the funding side, right? Figuring out what your mortgage, who your mortgage lender is going to be, if you're going to do a private money loan, hard money loan, how are you going to refinance, what percentages. So you did most of the heavy lifting at the beginning. The things to keep in mind while you're refinancing is do not make any large purchases during this period of time, because any large purchases can throw off your debt to income ratio. And if it throws off your debt to income ratio, it may not no longer qualify. And you don't want to be stuck with a house that now you don't qualify to buy. We see this happen a lot, especially with buyers. They get a contract accepted on a house, they get excited, and all of a sudden they start shopping before they even own the house. Now all these credit hits are getting hit on their credit score, and then they're taking out all this money and all this. Now all of a sudden they can't afford the house because it threw their debt to income off. So don't do that to yourself. Another thing too is be careful even with large cash withdrawals, because that's going to affect your reserves, right? So even if you say, okay, well, I'm not putting this on credit, I'm going to take out cash, that can affect your reserves. And especially if you're picking up more than five properties and up, they require an even larger reserve per property that you hold. So you want to be careful with that. As soon as you're getting in the process of buying a house and you're going to refinance, don't spend any money. All right? Don't apply for any loans. Don't do anything. Stay still and refinance that property. Then do whatever crazy things you want to do. But in that process, you want to make sure to do that. You want to make sure to protect yourself and not do any of those things, because it will throw it off. And again, you don't want to be stuck with a house that you now cannot refinance. All right, it's going to be a terrible process. So that's with refinancing. Again, there's a lot more involved, but this is the 20,000 foot view, the quick tip on this. And the last R, if by the end of all of this, you still love the process and you're like, man, I want to do it again, the last R is repeat. All right. In this process, one thing to keep in mind is you don't want to chew up your cash flow. All right. You want to get your cash flow and build up reserves. So the reason you want to do that is because you just don't know what could happen later on that property. So you want to make sure, our rule of thumb is about $5,000 per house. But that also, there's a lot of things to take into consideration. Did we renovate the whole house already? What are the major things that we didn't touch that could go wrong? How many houses do we hold, right? Because after you hold maybe 6-7 houses and you have $35,000, there's very low chance that all 6 houses are going to go wrong at the same time, and you're going to need to spend $5,000 at every single one of them, right? So maybe once you hit a certain threshold of reserves, you're probably more than not safe to just not have to keep building that reserve up, right? So you want to make sure your first order of business is build a nice little cushion, a nice little reserve. So that way, if anything happens, you don't have to, scramble, pull debts or anything like that to take care of it. And you do that using the cash flow. And then you also want to keep an eye on the market. You want to look at that local market, run analysis every 6 months to 12 months, see where that market is heading. See what the competition looks like, what other rentals are coming in. Are there anything that you want to be upgrading or changing on your property to make yourself more competitive, better to the market, so you can keep renting? So pay attention to your local market, especially in that subdivision. Is there construction coming in? Is there, new things being created, all these things? Or is the market slowing down? Maybe you should start considering putting this house on the market at the next tenant turnover. So keep an eye on the market. That's going to tell you whether to step up or sell it. All right. That's very important. And then one little special tip that we like a lot is velocity pay down, right? So once you've built up your reserves and you have multiple properties, what we like to do is you take all of your cash flow and pay down the house that's closest to being paid off, right? So you take all that cash flow, because a lot of people say, but that's the cash flow. I want the cash flow. You need to build something before you reap from it, right? So you can't just plant a seed and go the next day and try to pull it out. Let that portfolio build. Give yourself, I would say, about 10, 15, the longer you can give yourself, the better. But I would say 5 to 10 years is a good amount of picking up properties and letting them build. But let that cash flow sit there and don't pull from it, but take that cash flow, roll it in, and pay off the property that's closest to being paid off. Once you pay that house off, the cash flow on that house is going to go up substantially because you no longer have a mortgage. Now take all that cash flow, combine with the rest of the cash flow, and pay the next property, and so on. Then what you have now, you have properties that are paid off completely, immense amount of cash flow, and if a good deal arises, you can refinance any one of them, right? Pull that money tax-free at a low interest rate and go invest on your next property. So it gives you a lot of opportunities for future growth, right? So that is the biggest part. Once you're done with rental, all the advantages you have moving forward. And then, of course, now that you're doing this, you repeat the process. You go and buy another rental, do all the same things. And you want to stay in constant contact with your mortgage broker and lender just to determine, like, hey, how's my debt to income ratio working out? Do I need to wait a little bit? Do I need to make a little more? Do I need more reserves? What do I need so we can pick up more rentals? What are my limits, right? Usually to use like Fannie and Freddie Mac loans, you have a 10 property limit per person. If you're married, you can probably get 20, 10 each, but you're going to have to make sure the deeds are in each other's names, not together, right? So you got to do that separately. And I have heard that it also matters what your combined income is going to be. So like if you're choosing your spouse to have the property under their name, you got to make sure that they have the income and base to support that loan, right? Because that person is going to qualify for the loan. So you got to make sure that makes sense as well. So that's pretty much, again, huge 20,000 foot view on how we pick up our rentals. I do want to go ahead and take every step of this and really just hammer down and expand it further, step by step, on how we do all of this. So I'll probably be moving on to that next. And if you have anything in here that you say, hey, I can't wait until next week or whatever, that I need to know this now, send me a message and we'll break it down further for you. So that way you don't have to make any mistakes, or you keep them to a very minimum risk level. So I hope you guys are enjoying this. I hope you get a lot of value out of this. And please, again, like us, let me know if you have some, questions or anything like that. And stay tuned and subscribe so you don't miss any more episodes. And I will catch you guys on the next one.